believe the stock market now is very vulnerable to a crash or a very hard fall. Up until now, I began the year thinking it would finish either side of unchanged, but for a whole host of reasons, and I'll run through them. The concern now is that we're in this final leg, I believe, of a melt-up kind of atmosphere where doesn't matter what era whoever is at that point in time thinks this time it's different, and it always ends up never different. The circumstances may be somewhat different, but the actual results are. So the first biggest concern I have now is that the stock market has gone into a phase that I couldn't first begin to buy. And one of the things that complaints over the years of money management and what have you, people used to say, you guys and gals always tell us when to buy, but you never tell us when to sell or sell at the right time. And my answer always is, well, can you first buy now? And if you really can't first buy now, then you have to ask yourself, well, who is gonna and pay more and more for what you still are gonna own? I couldn't begin a general U.S. stock equity portfolio now. There's too many circumstances, economically, socially, and politically. Economically is probably the most important one. I think it's important for people to understand this. It's not often spoken on Main Street, Wall Street, but our Secretary Treasurer in his early part of his career brought this to bear, and I think it's very worthwhile for people to think about it. He noted that here in the United States, the 10% wealthiest people own 86% of all the assets. The next 40% own the remaining 14%, and then the bottom 50% unfortunately really don't own assets. We have a K economy now. The upper echelon are doing extremely well. They're benefiting greatly, and of course from stocks, that helps as well. But when you get to that middle group, and especially the lower end, where now the bottom 50% of income earners, 25% are using credit cards just to pay for food, gas, rent, whatever it may be. We're seeing the decline in the area which is important. The upper echelon doesn't feel it, but history never allows that upper echelon to pull a lot of those people up. Eventually, as more and more people are struggling, eventually some of that good stuff at the top gets pulled down somewhat. That's the easiest and shortest way for me to describe it. The other problem that I have is the political. If and when we have this next financial crisis, and I believe one will come, I don't know when and where, we don't have the political power now to go into a room with two parties to do whatever's necessary to fix it. The political paralysis now is probably as bad or severe as the separation was before the Civil War. There's literally two ways of thinking here, and the middle ground is gone. So the political aspect isn't there to be bullish and excited. Not to say also that as a firm, we manage a lot of small businesses' capital, and small business owners just keep telling us it's more difficult now to run a business than any other time. And I don't mean just as Trump came in, over these last few years. And then socially, all the issues that are happening socially that aren't bullish in my opinion. And therefore, I can't see myself going out and starting a large general U.S. equity portfolio. Now, I'll just add this. I'm on the opposite end when it comes to an area where a lot of people are not focused, metals and mining and things of that nature. But I'm also willing to own equities outside the U.S. I'm still highly favorable to the Chinese stock market, some others, Singapore. But I think overall here in the U.S., we're in the most latter stage of a bull run, which now has the capability of giving a lot of it back in a relatively short period of time, but still possibly from higher levels than even we're at now. There's three factors. First of all, you might as well, if you do watch one of those networks where the anchor people are down at the stock exchange, that might as well be a museum. Much of the trading is not taking place there, and I bring that up for two reasons. One, when I entered the brokerage business in 1984, almost 90% of the trading was retail investors. And retail investors did what the stock market was originally created for, a place to buy and sell part ownerships of business. Only about 10% was institutional, and there was no computer trading at all. Now, over half the money that's in the stock market is in passive investments. These are funds, exchange-traded funds, mutual funds, etc., that are not being actively managed or being asked to actively manage. They're basically being managed to track an index or an indice. And therefore, the money manager, he or she, when they get money, their obligation is just to keep that exchange-traded fund relative to whatever it's tracking. And the biggest popular one is the S&P 500. But with that became almost a self-fulfilling prophecy to drive the market higher, because as new money comes in, they can't sit there and go like I'm doing now, wait a minute, the market's too expensive, I don't want to buy any stocks. They have to buy stocks. And that's one of the reasons why there was such a narrowness of the movement at the upper echelon stocks, particularly technology and all. The other half of that money about that's left in the market, 2/3 of that is being driven by computer-driven programs, algorithm programs, which could be simply just because certain words and news come out and computers act, or very complicated, sophisticated programs. The smallest percentage now is what used to be the largest percentage. Just people buying stocks to be part ownerships of businesses and all. So what we watch and what we influence, and I tell people like me with gray hair or no hair left, what the market was 30 or 40 years ago and the rules you used back then, throw them out because it's a different species. The other important part of that is most people don't know this yet, but they're going to learn when we get that hard decline. We have what's called black pools now. This is where large institutions are trading off the major exchanges and just among themselves. So when I meet people say they sit home and I'm trading, and I'm saying, yeah, you're trading with only half the deck. Half the deck you're not even getting to see. But the influence of that and the large scale of that amount of trading, while everything's going well, works well, but the opposite's going to happen if for whatever reasons people decide one day maybe this isn't the best time to own stocks. The other concern I have, and this people say, well, it's easy for you to say it, you're this old dinosaur from the 80s. But I'm very concerned now of the educational understanding of the professional community as well as the investors themselves who haven't really experienced anything but a one-way street. Now, I don't blame them other than a sharp downturn. And, when COVID hit, the vast majority of financial advisors now are in the business less than 15 years. Certainly not back to the 87 or even the 1999 decline. So they've learned to drive and think the road always goes one way. You put the gas pedal to the metal. And if there happens to be an accident, this Fed comes along with this tow truck, they do the Fed put and the road's open and you go forward again. And that's the mentality also now among a lot of investors. So I just think there's a lot of things that aren't, and listen, I don't expect to turn on the financial networks and hear that because the financial networks are supported by the very people that are doing those things. I don't think they're going to come and share things that may give people concern and so forth and so on. Doesn't mean they're being dishonest. It's just, don't ask, don't tell kind of an attitude. But I do think that is one of the biggest concerns that I have right now is that we have this, I don't want to say it's artificial, but it's stimulus that's moving the market that can change. And one other thing I'll just add, and this does cause some grief by about half the population, and that is while Trump, I think, has done marvelous work on things like law enforcement and immigration, what he's decided to do here regarding a trade war by taking in a big stick instead of an olive branch, I think is going to come back to bite us. And it's almost a certainty at this point in time. First of all, the economic numbers that are coming out will give justification to the Fed, but the undue pressure that has come from this administration, particularly on the head of the Fed, a Fed cut is coming. We have been weaned, like you said, especially from the financial media, that a lot of them that are tied to the hips of Wall Street, that when interest rates are cut, stocks always go up. And that has helped because of all the deficit spending or the creation of money that's come out there. When I entered the business, I didn't know what $1 trillion was. I wouldn't tell you, I wouldn't know how to compute it. I wouldn't know how to explain what something adds up to $1 trillion. And now we have $37 trillion in debt. And I don't think America still understands the ramifications, the simplicity of why that's important. So forget about ever paying that back. But we have to continue supporting the interest payments on it, no matter how the government figures out how they're going to refinance. Like now we've used some trickery in recent weeks and we floated real short-term paper, but we now saw again last month we spent 300-something billion more than we take in. That can't continue because what happens is eventually, even at a low interest rate of 5%, if we're going to be at $50 trillion, which the Congressional Budget Office now says could be as early as 2033 now, because of the way the deficits are, just put a 5% interest on that. That's $2.5 trillion. We only are averaging about $6 trillion maybe in revenue. 2 years ago was our best year. And even somehow we increased that. And then if you want to consider how do you make that payment when half of all our money would just pay the interest, our single biggest asset on our books are student loans. They're over 25% of all the assets that America, it's the largest single asset that we have in our books. Well, we just seen a record 13% of student loans gone into almost foreclosure, like that people owe so much they're never going to pay it. So I don't know if we continue how much longer to the point of people outside the United States who are not exactly friendly with us at this point, and who many of them are now in this trade war mentality battle with us. Are they going to be just keep willing to buying our debt and buying it with a very low interest rate? So the surprise that I believe is coming, and this is why I went this long to tell you, is over the next year or two, we could see interest rates go lower on the short end, but the long end interest rates may stay at the same or actually go higher, because it's going to become harder and harder to finance our debt because of how we're still treating deficit. There are other governments that have their own problems. Japan is one of them. If you think we have a problem right now, they have even a bigger problem in their bond market and with demographics and all that kind of stuff. So what I'm just saying is the lower interest rate argument, which is propelling the stock market now in recent days, and you're going to turn on those so-called financial networks, and that's all the talking heads are going to talk about and tell you it's all good for the stock market and all. But we don't have that much more time till we're going to get to the point where we're going to start to have real serious stuff. And if you look at some of the smartest, biggest minds that control billions of dollars, they're all coming to that same conclusion now, that the period of time has gone from Ray Dalio to all others. And it is. And I still find while that's happening, that investment public that you were talking about and the people supposedly that are professionals are like drunken sailors without any concern and think the party's going to go on forever. And that's the other reason why now I become, so gravely concerned.